Welcome to today's Power Series webinar featuring Tricia Rothschild, hosted by CFA Society Chicago's CFA Women's Network. Information on upcoming events can be found on the Society's website at www.cfachicago.org. I'm Chris Vincent, CEO of the Society. All mics for attendees will automatically be muted during the event. If you would like to ask a question, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Jennifer Aronson, Managing Partner with Mosaic FI, LLC. Joining Jennifer for today's discussion is Tricia Rothschild, President of Apex Clearing. Tricia is responsible for the overall growth and development of the company and its three core business lines, and directly oversees internal and client-facing functions, including product management, sales, and marketing. Prior to joining Apex, she spent 26 years in a variety of roles at Morningstar. In 2020, Tricia was recognized in Investment News' Women to Watch program and was named one of the top 21 people who will change wealth management in 2021 by Financial Planning. She was also featured as one of the top women in wealth tech by thinkadvisor.com in 2019. I will now turn it over to our moderator, Jennifer.
Thank you, Chris. And thank you to the audience for joining us today. And of course, thank you, Tricia, for agreeing to present to us the world of fintech from your seat at the table. I look forward to hearing your views on where the future of the industry is heading and how fintech is bridging the gap between trading and investing from the retail investor's perspective. Fintech is a catch-all phrase that applies to many facets of the technologically enhanced financial world, from robo-advisors to online lending and banking, to automated back office operations, to retail trading platforms. Fintech has influenced many facets of the financial world. Most recently, there has been a lot of focus on the retail trading platforms. So today we're going to get a perspective that is not front and center when you think about fintech, but for trading platforms, it is the clearinghouse that provides the foundation that allows these platforms to function. So Tricia is going to start with a brief presentation that will lay out the framework of the influence that fintech has had on trading versus investing. We will then move on to some Q&A questions that have been prepared by the CFA Women's Network. And then we will move on to Q&A from the audience. So please feel free to post your questions using the Q&A function at the bottom of your screen, and we will do our best to get to as many questions as time allows. Tricia, now I will hand it off to you.
Great. Thanks, Jennifer. And thank you, Chris, for the virtual introduction. I should let you guys know that in addition to being a proud charter holder, I'm also on the Board of Governors for the Global CFA Institute, and happy to be part of the Chicago Society, obviously, which is where I've lived since I was 18 or so years old when I left Wisconsin and came to Northwestern University for my undergraduate. So there's a lot of great connections for me with this group and with this topic, which I definitely want to say, I have been thinking about this completely unrelated to the events of the past couple of weeks. I mean, this has been something that has been on my mind since I joined Apex Clearing last summer. And I'll tell you a little bit about why that is. But I guess I just think that it is really a pervasive and really interesting intersection that does have a lot to do with technology, does have a lot to do with demographics, does have a lot to do with how digital natives and the younger generation kind of just engages with the world and with their money. And I approach this topic, frankly, with a lot of optimism. So even though there's, some maybe tension and there's been a lot of recent disruption, I think ultimately there's, as the title on the slide says, dramatic change occurs when market power shifts. And so that is, I guess, the premise of my thinking, and I'm really looking forward to our discussion today. So on the next slide, this kind of just, it'll show you a little bit about how I've been approaching this, and is just, people orient themselves to their world in different ways. And you can say, like, I'm a beach person for vacation, or I prefer to go camping, or I'm a dog person or a cat person. Or more recently, you can talk to your friends about whether you would love to work at home as soon as, COVID is over. You really have gotten kind of used to that and you like that, or you're really eager to get back to the office and you prefer, doing your work in an office environment. I actually kind of have always thought about trading and investing in a similar way. And I personally very much identify as an investor. And that's a lot of just, I think, the great experiences I had growing up at Morningstar. I started as a closed-end fund analyst. I came into that role without having any particular background in investing. I had studied international economics, and the transition from centrally planned to free market economies with my master's program, but I wasn't really considering myself an investor until I started to understand the approach that Morningstar took to valuing companies and thinking about accumulating long-term wealth. And I remember joking with my friends who on Fridays would ask me what had happened in the market. And I would say, I have no idea what happened in the market. And they would say, well, aren't you an analyst? And I would say, well, yeah, but I'm looking at the fundamentals of what's going to happen over the long run. And as I got my CFA, and certainly I'm sure all of you as charter holders can relate to that, I really identify as an investor. And increasingly, especially as I learned more through my role at Apex and was attracted to becoming the president of Apex, I've been thinking more about that intersection between trading and investing. On the next slide, we did a little, a little game, I guess, to think about what words do you associate either yourself as a trader or investor, or what words do you associate with trading and investing. And if you guys want to use the chat function to put the words that you associate with trading or investing into the chat, I'm kind of interested in continuing to build out these word clouds over time. On the trading side, right, there's that notion of short-term, quick returns, a lot of self-directed, not necessarily using any kind of guidance, particularly the commission-based word, which now is no longer relevant. Those are the kinds of things that come to mind for lots of people when they think about trading. Investing is generally seen as a longer-term time horizon, saving for a goal down the road, more often affiliated with an advisor or having some kind of guidance, maybe somebody to prevent you from your own bad behavior, which we all have biases around short-term thinking and the risks of short-term thinking and staying the course. Increasingly, there's, I think, new things coming with investing around fractional share portfolios and custom portfolios, which we can talk about when we talk more tax efficiency. I see that one popping up on the chat. Absolutely, the types of things that you can manage more effectively in a longer term time horizon, I think tend to come to light from an investor perspective. So against that backdrop, I was reflecting a little bit about what are the trends that are driving what I see as a convergence. So kind of unlike this bifurcation that we just talked about, like the starting point of this versus that, I don't know that that's going to be true in the future. And it's the intersection of those two things that's so interesting. So why is that intersection happening? And these are some of the drivers that come to my mind. So starting at the top with the demographic and regulatory shifts, there's $68 trillion of wealth that is going to be shifting hands over the next 10, 15 or so years as the older generation passes away and that wealth is transferred down to the younger generation. The folks that today are under the age of 40 or under the age of 30 are going to be in a position of kind of a dramatic, you could call it money in motion. And as that shift occurs and you think about the way that younger folks today are already starting to engage with their money, it's not so much that they have necessarily all that much money today, but they're digital natives, and how they think about their financial futures will definitely change, but I think the digital part of it will stay. And so that is where I see some of the more innovative or tech-forward investing apps already starting to shape what that future will look like. And then you can also think about women as part of that demographic. So right now, I think women control about 10 trillion, about a third of total US household assets, and that's projected also to triple in the next 10 years. I know Sally Krawcheck spoke at one of these events last year, and I'm sure there was a lot of great information that she shared about women living longer and needing to take more control of their own financial futures. So that's another change in how women in general think about approaching money and being maybe more goals-based and thinking slightly differently about risk. So I think that probably has not yet fully materialized, my personal opinion, in terms of options and apps that might speak more to how those types of behaviors can be realized more intuitively. But I'm sure that there's room for innovation there too. The idea of scale versus boutique is really interesting because there's been so much consolidation already in our industry. Last year, there were 553 financial services M&A transactions, 259 of them around retail banks, 186 M&A transactions, including investment management firms. You can see the consolidation in asset management firms pretty clearly. But then you can also see the need for certain types of scale or niche players. And when you think about how fintech can facilitate that, I would imagine you can see the larger firms trying to enliven or energize their own tech stacks. And then you can see the niche players using technology maybe in a more kind of native way, both to facilitate the investment management process and also to extend their reach. So it's more cost effective for them to reach customers, even though they may not have, quite the scale of the larger players. But I think the firms in the middle, that's where you start to see the shaking out kind of happening and a little bit less of room for kind of a mid-tier service provider in our industry. The next, I don't know if it's really a trend as much as it is a conundrum, which is the paradox of choice. And it is, it used to probably be true of the mutual fund industry, right? Before mutual funds started to consolidate and a lot of the middling players or the higher expense funds started to shut down or get retired, you could have said there was a paradox of choice with mutual funds. And I would say now there's that same element of almost overload with fintech apps. So I pulled some stats for this. So in 2019, there were about 5,800 fintech startups in North America. And in 2020, that had increased from that 57 or 5,800 number to 8,775 fintech startups in North America. And at Apex, actually, we support a lot of innovative businesses that are coming forward with different types of business plans to solve different types of problems. And at Morningstar, I also got to see a lot of startups who would come through and ask to license Morningstar data as part of their business plan. So I love to see the innovation, but I do think it can be overwhelming for advisors and individuals to sort through this sea of choice. It is true that 2/3 of consumers have used one or more fintech platforms worldwide, and that's double what it was just in 2017. So more choice is leading to more usage. And I'll talk in a little bit about some of the convergence between those business models that I think will also continue. And then the last point here, which I back to my statement at the beginning about a sense of optimism that I have for where the industry is heading, is this idea that Wall Street continues to move to Main Street. And this started with the mutual fund movement, for sure. I mean, that was a tremendous development as it related to democratizing investing and allowing people who previously didn't feel like the stock market was for them. Mutual funds definitely allowed people to participate in the equity and fixed income markets with better diversification at lower price points than they previously would have had available to them. But I would argue that that is continuing to evolve through both the activities of Wall Street and through the activities of the tech capabilities that are coming forward. So from the point of view of Wall Street, you see Morgan Stanley buying E-Trade, and you see Goldman Sachs acquiring United Income, and also BlackRock acquiring a custom indexing solution called Aperio. So these firms are thinking about how they can continue to offer cost-effective investment information to not just the ultra high net worth customers, but to provide personalization at scale in a big way. And I'm interested in, frankly, just to see how that trend continues. And that to me is the future evolution of mutual funds as it evolves to ETFs and then continues to go toward even more custom indexing solutions, which will allow, I think, ultimately even better investor outcomes. So what specifically is happening in the fintech landscape that is kind of playing upon these trends, driving these trends, causing this change? This is a image from a research firm called CB Insights that shows a variety of fintech startups. And as Jennifer said at the outset, fintech is a really big word. It can mean everything from back-end payments to systems, to lending, to front-end kind of investing apps and robo-advisors and so forth. What's interesting, and I see this through my Apex world, is this convergence of the silos. So you might start with an investing app, and then you start to think as a business owner, I should add banking. Or you might start with the banking app and you think I should add investing. And then if I add investing, that would naturally lend itself to lending. So a lot of these apps, and I think this image is kind of meant to show that the one thing that is in common across all of them is access to the paycheck. And that is where, most people's first interaction as, I don't know, a teenager or, a young adult was getting your first paycheck, or maybe getting at this point your first babysitting deposit on Venmo from the family that you're babysitting for, and having that dropped into your account. That is the starting point. And from there, people can start to build out. One of the more interesting things that I think could happen with this particularly is thinking about where consumer or retail firms might start thinking about that intersection. So Walmart recently hit the press as saying they were going to be expanding into some type of investing program. And the details weren't at all disclosed, but you could kind of see where, if you have a large customer retail base like Walmart, you might be thinking about, well, what else could you do to serve those customers? and you have access to their consumer life, are there other things that would spawn off naturally from that? So I think that'll be an interesting trend to watch. And I will just say, I do think back in that regard to, was it Sears offered investment products at one point, or and that didn't really work at that point. People weren't really going in to buy their washing machine and thinking about also buying an investing product. But perhaps given the digital nature of where things are at now, that might cause a different perspective for people when they're thinking about their consumer behavior and their spending behavior, and then that leads potentially to their cash management behavior and their investing behavior. So those are some of the trends that I find really interesting that I just wanted to bring to bear here as a starting point for our conversation. And then the next slide just basically kind of brings us back to that beginning, which is maybe instead of thinking about like investing in this one very specific bucket and trading in this other very specific bucket, the convergence of these two behaviors fueled by fintech kind of causes all of us, right, in our industry. Like we're all here as CFA charter holders. We've invested in ourselves to get to this point, to have this understanding. And what role do we play within our organizations, within like educational aspects and things that we can do to educate, to promote better behavior, and to maybe try to ensure at least that people understand what risks they're taking. And as friction is reduced, like that, the speed bumps are gone, and that can be dangerous, right? Like guardrails can serve a purpose, but I also think that we're not going to go backward. And I think we'll have to come up with other ways to ensure that the right amount of friction is there. And frankly, I would rather be able to choose how that friction is applied as opposed to have it imposed upon me by outdated technology or some other bad system. So I think that it gives us a little more choice. And that leads me to my final, statement that I wanted to leave before we open it up for Q&A and Jennifer and I have a chance to talk, which is this notion that change happens at the speed of trust. And I read an article last week, which was what got this thought in my head, and it was about neobanks. And it said, neobanks will ascend at the speed of trust. And then you think about what happened with the recent trading volatility. And I just feel like there is an intersection here that's super important. We know in our country that there is less trust in our financial institutions than we probably would like. And the extent to which we all collectively can absorb the change that's happening will, it definitely requires us as industry participants to regain that trust, and also fuel innovation. Like those shouldn't be mutually exclusive things, but they're definitely interdependent. So I'm happy to take more questions and just engage with you guys on where things are heading in the industry.
Well, thank you, Tricia. That was really helpful. I have some prepared questions that, as I said, the CFA Women's Network has put together. And then again, we're going to open it up to audience questions. So again, to the audience, please post any questions using the Q&A function, not the chat, but the Q&A function at the bottom of your screen. So let's kick it off with some industry related questions. I do want to get a little bit into you and your career, but let's start with the industry questions. So, the GameStop situation took place almost 6 months after you started at Apex, after having spent 25 years at the front end of the business at Morningstar. What was your experience like from this whole new point of view from the custody clearing side of the business?
Yeah, sure. Well, I'll start by actually sharing kind of my personal experience over the past month or so, which really has to do with education. And I've been in this industry since I was 26 years old, and I have 3 kids. My oldest son just turned 25 on Monday. I have a 22-year-old son. He actually works at Morningstar now. And I have a 16-year-old daughter. And we have one other family who we shelter in place with. We have dinner together every Friday night, and they have 3 kids also. And all of a sudden, there's all this interest in what I do for a living that other than the 22-year-old son who works at Morningstar, nobody else in this group has ever really wanted to talk to me about what I do for a living. Although I will say the guy who shelters in place with us, the father of this other family, he's a CFA charter holder and he's the CFO of a biotech company. So he and I sometimes geek out over dinner about investing things. But the fact that there is so much interest in individual securities and trading and why it happens that way and who's benefiting and who's losing. I mean, it isn't how I think of investing, that is for sure. It is not how I would advise people to put their money to work, that is for sure. But I was kind of happy that we were able to have a conversation about what it meant. And I actually learned a lot from my 25-year-old in particular, who's not interested in markets, and what his observations were about what was happening and why this was happening. And the last point I'll make is it just highlights so incredibly clearly the need for more education and the fact that there can be this massive delta between the value of the business and the randomness or herd mentality around the actual trading and the mechanics of what's happening in the market was just it's crazy.
Yes, while you were having your high-profile conference calls, I'm sure into the night, the last few weeks, I too was having some pretty important conference calls with my 2 stepsons, 20 and 22, both engineers, in receipt and ownership of 5 shares of GameStop, wondering what they're supposed to be doing and where the market's going to go, and my insights on the market. And I just thought to myself, is this good, bad? I'm not really sure. Should I be happy that young people that know nothing about investing are, jumping in and, putting their money where their mouth is? So
did you come to a conclusion?
Well, I didn't tell them what they wanted to know, if I thought it would actually go to 35,000, by the end of the week. And I was not going to, give an opinion on that. But again, it was just, it was I had mixed emotions about it. On the one hand, it was, I've spent my whole career in this business, and now we have, a bunch of 20-something-year-olds that are, creating all this volatility. Is that good or bad? I'm not really sure yet. But that sort of goes to my next question. Going in light of everything that has happened over the last few weeks, going forward, how much of an influence on the markets does the retail trader have?
Yeah, well, and I guess back to our language, right? I mean, are we talking about traders or are we talking about investors? Because there is, a possibility that people will, become more self-directed investors, not necessarily just manic, crazy traders. I mean, right now, retail investors account for about 1/5 of the US stock market's volume. Liquidity has definitely increased significantly over the past year. And I hesitate to say kind of, using the word influence. I think that's a hard thing for me at least, to assess the influence, but I think the engagement will definitely continue. And that is why I actually think it's such a fascinating topic, and it's so important to pay attention, because we can improve the outcomes, I think, as an industry by just understanding that there will be more engagement in the market because of the reasons I just mentioned in the prepared remarks around the demographic shifts, the technology reducing barriers to entry. Those should all be good things, but they just, I think we could do a better job probably of educating people along the way in a way that's like relevant to them, not necessarily in like a CFA kind of way. No offense to CFA, but people are not all going to want to go get a charter in order to figure out how to engage with their money. But it is really important thing, and I think there will be more of that. So more opportunity maybe for the industry to influence retail investors, maybe put it that way.
Right. Yeah. And so kind of getting back to your point about the friction, the reduction in friction in the industry, what are your thoughts and perspectives on the forgetting the pay for order flow versus commission trading? That was obviously a big game changer for the retail investor or trader, whatever you want, however you want to call it. This ability, at least from the perception of the trader, to be able to trade for free. Is the pay for order flow a positive or a negative for that retail investor?
Yes, sure. I'm happy to talk about this briefly. And I guess the main point I will just say is that it is something that we should all be paying attention to. I think it's a really important topic to educate ourselves on more. And there have been some pretty good articles that have been starting to kind of come out, but there's also been some headlines and some snippets that I think are not quite telling the whole story as it relates to payment for order flow. So I would just encourage this group, frankly, to pay a little bit more attention to like what actually goes on and what is happening here. I actually myself just was like Googling it last week, and the CFA Institute has a really nice paper on payment for order flow that'll come up probably at the top of your Google search. But I would say it's not perfect. The payment for order flow system isn't perfect, and there are ways to improve it. And at Apex, we have talked a little bit about how we could maybe think about things a little bit differently or better. But net, it is not the root of all evil that I think there is some momentum around this fact that it is wrong or bad. Maybe some of it is just the language. Payment for order flow doesn't sound great, but some of what's embedded in that is price improvement for small investors. So if you are trading a fractional share or a small number of shares, and you take that order back to the exchange, you're not going to get the same execution. And so the individual investor has benefited from this practice. And so there's no commissions, and so that's a savings. Again, it's a reduction of the speed bump, and you could argue, well, there should be more speed bumps, but I would rather choose my speed bumps than have them imposed on me. And so I think that it is a practice that, like I said, it can be improved, but it isn't inherently flawed or conflicted, and it can add a benefit for sure. And it can be documented. I mean, the research or the data will show you kind of where the price improvement around execution has flowed and made its way through to a small investor.
And do you think that, because from my perspective, the biggest issue, because I sort of think that it is actually for the small investor that's only buying 10, 15, 20 shares, that the payment for order flow versus paying a commission every time you trade is probably a net benefit. The issue is the transparency. You know you're paying $9.95 or $5.95 for the commission. How do you know what you're paying for when it's commission free?
Yes, no, I'm so glad you brought that up. And actually, that is the other piece of all this that I think just in general, and this is one of the reasons I actually joined Apex, frankly, is because I realized after spending all these years thinking about asset allocation and portfolio construction and investment screeners and how you could find the best investment for you, what happened below the waterline? I had no idea, really no idea. And most of the people that most of the people that I knew didn't really have any idea either. And I got this book called After the Trade is Made. And, you know, it's really important what happens after the trade is made. And it is important who custody and clears your transactions. And whether you're a professional investor or an individual, you know, retail investor, I think that it's not as maybe obvious, except for maybe now it's more obvious, but and it, you know, it isn't, you don't see that when you're using your investing app for sure, but it is critical to the functioning of the market. But and the transparency around that is a place where I think, you know, we can improve or, you know, do a little bit more. It reminds me a little bit, Jennifer, of the Department of Labor regulations, when there was the, you know, everything was going to be fee-based and there's no room for commissions, you know, as an advisor at all. And you're like, well, that's not always true. I mean, in certain cases, for certain use cases, or in the UK, they banned, you know, all of it. And then there were all these orphaned investors that the advisors couldn't afford to serve anymore. And then those poor folks weren't getting any guidance whatsoever. So I think it's a little more nuanced, you know, and specific to various use cases, time horizons, how much you're investing, you know, at one time. It just requires a little more subtlety.
So then along those lines, and in light of what, you know, the attention that, you know, the industry has gotten over the last month or so, what regulatory changes do you see coming through as a result of all of this?
Yeah, I mean, it's hard for me to prognosticate on what regulatory change will or won't happen. Unrelated to the GameStop thing, I will just say, I think one of the kind of more unfortunate regulations that will be overturned probably now under the Biden administration is actually related to ESG investing as it relates to retirement plans. So there had been some restrictions that were apparently going to be imposed on that. And I think that having those overturned will be much better from a sustainability perspective as it relates to retirement plan investing. That's not really a regulatory position as it relates to any of the recent trading activity, but it is something that I think I would advocate for, and I'm excited and hope that allowing people to have more back to visibility and transparency, more ability to invest along with their sustainability preferences, and making that more clear in the context of a retirement plan, which is where most people have their investing happening anyway, would be really great.
Mm-hmm. Okay, so let's shift gears and talk a little bit about you and your career. So you have this wonderful, impressive background. What can you tell us that many of us might be surprised to hear, or something that, you know, new we can learn about you?
Well, from a career perspective, I would just say it was very important to me when I started working, and I got married around the same time that I started working at Morningstar when I was 26, and it was really important for me to have some sort of work life, like throughout the time I was raising my kids. So just that idea that I really wanted to kind of try to balance, like, you know, raising my family with my career was something that was always really important to me. So I say that only because I guess the thing, I didn't like set out to have like this massive career. I didn't really consider myself to be super ambitious, but I was so interested. I'm just interested in the topic, and I have been lucky enough to find like a group of people when I was young that stimulated my thinking, and I just found the work of being in the markets and thinking differently about investing continually, and then adding technology into that, and now thinking a little bit more about how markets function. It's more intellectually stimulating to me than anything else. So I don't know if that's surprising, but I guess I don't always think about it as like work. I think of it it more as just interesting.
Yeah.
And on a more frivolous note, I can say this, I don't know, this maybe would be surprising. I'm really organized with like processes and logistics, and I am super disorganized as it relates to like paper and any type of like paperwork or any organizational like details like that. I'm really bad at that. So that might be surprising. I like to organize my schedule, but I don't like to organize my paper, and my office is always totally a mess, and my backpack is always totally a mess. So
your own method to your own madness,
I guess, yeah.
So let's talk a little bit about diversity in investment management. There's been a lot of attention on this lately, and we've seen companies spend a lot of time, money, and good intentions on efforts to promote diversity. Do you think there has been appropriate progress over the last 10, 20 years? Do you think we've been successful on this path?
Not really, no. Which is sad to say, because I do try to look for the bright side generally. It's just my nature. But I think it's hard. I'm happy that there's more conversation. And I'm happy that there are probably both more men and women, just like people in general who are understanding that it's not great, it's not right, it's not helpful. We're missing a lot of value because of the barriers that we've kind of self-imposed upon ourselves. So I guess that part is there's maybe a little improvement there. If I'm thinking back 10 years ago, I maybe probably would have felt more alone, like with you, like other women, and we could talk about it, but I didn't really feel like I had the support of men in general. And I do feel much more so now that it is on like everybody's radar, that this is everybody's problem, and it is not just my problem or your problem. Like we collectively have a problem. So that is, I guess, a positive. But that hasn't yet led to super consistent outcomes.
And speaking from the CFA Society's perspective, I mean, we struggle with, such low membership of women. The Chicago Society is somewhere around 13%, and we still struggle to try to get that number up. So yeah, I don't think anyone has found the easy answer to that. Do you have an example of anything that's helped or added value to either your firm or something related to the investment field?
Yeah. There's a couple things I can point to that are more maybe practical. And one of the things that I really am excited about within Apex's world, Apex has a parent company called Peak Six, which is a Chicago-based trading firm, privately held, and founded and still run by Jenny Just and Matt Hulsizer. And they together have launched this really cool program called Poker Power, which aims to bring more risk-taking and confidence-building skills to young women and professional women through the game of poker. So you're not actually gambling, but you are, at the table, placing bets, taking account, being accountable, failing, betting again, understanding kind of, what your risk parameters are, and owning it. And I think that is a super practical way. One of my personal frustrations is I see super competent, smart women almost always in support roles. And I don't mean like support like an administrative assistant, but like support through human resources or support through marketing or support, like, well, where are the capital allocators? Where are the P&L owners? Like the men make mistakes too. You don't have to be perfect to deserve the job. And I was an analyst when I started, my career, and I very quickly for my own personality, I was like, well, I don't want to just analyze somebody else's mistakes. I want to make my own mistakes. And so that to me was kind of inherent to my personality. But I think that maybe in other cases, especially with women, it might be less comfortable to visibly own your own mistakes. And I think the Poker Power Initiative kind of forces you to own your own mistakes, but then you realize that you can just move on from that. And I think that's ultimately a very kind of confidence building thing to see and to do. So that's one thing that I'd point to.
Okay, so I want to give the audience the opportunity to ask some questions. So let me pop over here and start asking you some of the audience's questions. So we have what prospect for greater expansion of direct indexing technology and its impact on the mutual fund and ETF industry?
Oh, good. That's a great question. So when I was at Morningstar, and I'll just, not to make this a commercial for Morningstar or anything like that, but I think one of the firm's greatest assets is the index business. And there are very few independent index businesses in the world, frankly. And what I think is so interesting about direct indexing or custom indexing, whatever you want to call it, is the ability to move beyond like the packaged product world. I mean, there's just a lot of inefficiencies in the way the industry has packaged these products together. I mean, it's over. It should be over, in my opinion. And even John Reckenthaler, who's one of the he was at Morningstar before I was at Morningstar, which was a really long time ago. He just recently wrote a column about the demise of mutual funds or something like that, because the wrapper, the product structure, obfuscates some of the benefits of the strategy or the investing, merits of the actual security selection underneath. And ETFs, kind of evolved that a little bit, but custom indexing brings it even further along, where you can manage the tax implications, and increasingly importantly, you can tailor it to your own specific values and make it really relevant to your personal situation. So it's kind of like like separately managed accounts, but coming downstream, back to that thing of Wall Street coming to Main Street. Separately managed accounts don't have to be something just for people with, whatever, $250,000 and up or $500,000 and up to access anymore. So it does require, a nice kind of like user interface and workflow. It requires the right type of rebalancing. It requires different type of reporting. So I think that there's a lot of room for innovation around performance reporting. And I would say that the understanding as an investor what your actual returns were and why that matters, whether it's relative to your goal or relative to some benchmark, that's an area that has so much room for improvement. But at the very least, the inputs into all that, like if the reporting will get solved at some point, there'll be better reporting, I'm sure. But in the meantime, the concept of direct indexing and custom indexing, I think, will bring more personalization, but still diversified, right? Like it's not like you're just randomly picking a couple stocks. So I think it's cost effective. You can also with a more relevant, if the portfolio is more relevant to you, I think you'll stick with it, so that it means more to you and you're not just gonna like sell because somebody missed their quarterly number or something. Hopefully because that you're investing for other reasons, but in addition to performance, but that there's other merits to the strategy. So, I mean, I'm sure, Jennifer, I don't know, like from your perspective as an advisor, where you see it going, but I think that might be interesting to hear too.
Yeah, well, I think first of all, just understanding, what that all entails, I think it takes some education. So, that's kind of the first part. So, how does that serve me and my clients better than just, pure indexing? So I guess that would be, you know, that would be where I'm at in terms of exploring that. So how has the recent fintech progress impacted the resources required for the front office, middle office, and back office?
That's an interesting question. So part of the fintech progress has led to this proliferation of choices, which is the point I was kind of making on that paradox of choice point. It's, in my opinion, there are a lot of innovations happening with these little specific point solutions. So if you want to have the best in breed financial planning or goals-based planning application and the best in breed CRM and the best in breed performance reporting tool, I mean, you can work your way around the, you know, advisor workflow and come up with like these single point solutions that all do something really great. But then you get into the middle office and the back office, and all of a sudden that data that you know, whatever you input into these systems or had to re-input into multiple systems, like it's not actually consistent on the back end. And so there's like a little clog in the pipes, I think. It's like the front end has moved faster than the back end allows. And that's a little bit of a problem. So, and frankly, that's actually one of the reasons I also kind of thought Apex was a really interesting place to sit for this stage of my career, is because we're thinking about things from the back end forward. So what can be done on the back end to facilitate a better experience on the front end? I mean, even something like crypto, right? Like normally, well, using normally and crypto in the same sentence is kind of funny, but currently, generally speaking, if you want to trade crypto, you have to have like a separate app, and it's all separate. It's not really part of your normal asset allocation or your normal anything else that you're doing with any other asset class. But why is that? Like, why couldn't that just be funneled more, you know, clearly into an integrated experience? Apex actually has the ability to do that, and we do that with one of the partners that we serve in the market called Webull. But in any case, I do think that there's a lot of interesting front-end development going on, and streamlining the data and making that part of the puzzle a little cleaner. That's ultimately where there should be improvements like yet to come. And then probably we wouldn't, if the front-end pieces are going to have to become a little more integrated too. So it's nice to have these point solutions, but I don't think people necessarily. I think people will be happy enough to have a good experience, even if it's a little more integrated. Like you can get the B lineup if it's really integrated and easy, as opposed to the A lineup that's like really disaggregated and hard to use in a total experience.
Yeah, and I would say from our perspective, making, you know, integration for integration's sake isn't always, you know, useful. You know, we have many systems that we work with, and a lot of them speak to each other, but not in a meaningful way. And so you're always asking the question, what's the risk of the sharing of data for this integration to take place? Is there enough value added to create that integration?
Yeah, exactly. And then you have to, it's not just the initial cost, it's the maintenance of it. And something changes in one system, but it didn't change in the other system. You don't want to lose like elegant simplicity, right? That's what we should kind of be after.
Yes. Yeah. Next question. Do you think peer-to-peer lending is still a viable business model?
I don't think I can comment on that.
Okay.
I'll think about it. Maybe I'll come up with something.
Can you talk a bit about your career role at Apex? Why did you decide to go there? What do you view as Apex's future, competitors, differentiation, and challenges?
Okay, dokie. Well, obviously I've thought about this a lot because I left Morningstar in December, right around New Year's of 2019. thought I would take a little bit of time off and just think differently about the rest of my career. And I reconnected with Bill Capuzzi, who's the CEO at Apex. And I actually just started doing some consulting with him and the leadership team there around how Apex as a custody and clearing firm could perhaps provide value in the advisory and wealth management space, which is not really where the firm's roots have been. The firm's roots have been in facilitating robo-advisors and self-directed brokerage. So firms like Betterment, really cool bank, a neobank or digital bank in Chicago called M1 Finance, really innovative Stash, SoFi, firms that are looking to kind of break down barriers and do things differently and make things easier for the end investor or saver or lender. But in addition, there is a lot of opportunity in the more traditional wealth management space to also think a little bit differently, and frankly, even helping asset managers bring investment products into the hands of investors in a more cost-effective, seamless way. So we recently launched a relationship with Franklin Templeton and a robo-advisor solution, for lack of a better word, called Bamboo. And Apex does the custody and clearing on the back end. And it's one super simple workflow. It's tied into the Franklin Templeton goals-based optimization engine. It can be kicked off by an advisor or done directly by a self-directed individual on their own, either way. It's 15 basis points all in. It includes the Franklin Templeton funds. Now, arguably, if you don't want Franklin Templeton funds, well, then that wouldn't be the workflow for you at this moment, but you could see where it could become open architecture later, or another system like that could do something like that. So to me, it's a place where, kind of, again, like I was saying, instead of innovating from the front end, it's a way to kind of innovate from the back end. And ultimately, that whole thing has to come together in order for it to work. It doesn't make any sense to have all these apps that are all spun up and super cool if the trading processing is inefficient. And if you can't open an account quickly, like, well, why is that? Like, my daughter, who's 16, I was just working with her, like, on setting up her first investing account, kind of because of the GameStop thing, right? Like she in high school, actually, she's also taking a consumer education class. And so it's been fun. I mean, most 16-year-olds don't really want to spend a lot of time with their mothers, but this is something that she and I can bond over. And she was like, well, what do you mean the market's not open? What do you mean I can't place my trade on Sunday night? I'm like, yeah, well, and then it's like, well, Monday's a holiday, so it's not going to happen then either. And oh, by the way, it's going to take 3 days to transfer the money from your bank account into this investing account. Well, why is that? Because there's this process called ACH, which, like, none of it makes any sense. And I just find, so Apex is working to kind of solve those problems, which I think is great, and it's important.
So that brings me to one of the questions. Do we need to protect new traders from the risks of investments that are likely to be highly volatile? Do we need to protect investors?
Okay, that's a loaded question. I am not sure in this country that protection is generally the way we have approached most things. And I'm not saying that as a personal point of view. I'm saying it more from, like, a cultural point of view. Certainly in other countries, there's a different approach to regulation and protection of all sorts, right? In the United States, we generally have, don't tend to come at things from the point of view that everything needs to be, like, protected or regulated. Now, that being said, things should be transparent. Things should be fair, whatever. That's a hard thing maybe to define. So maybe we'll stick with transparency. And certainly there should be ample education, and the education should be accessible and relevant. And I think that we do have an obligation to, again, I don't know if the word is, if protection is the word I would use, but awareness, options, understanding, trade-offs, like those are the kinds of things that I think we should focus on. And it's, money is as much behavioral as it is, anything to do with math, really. But, and people will learn. I mean, it is in a sense, it is a democratization, and democracy is messy, as we've seen. So I think that just means the people that have the understanding or the knowledge kind of need to step up and share it.
Okay, well, we're at the top of the hour, and I don't want to take much more of your time. So, so thank you so much, Tricia. This has been very enlightening, and we really appreciate you agreeing to do this. At the end of the event, you will see, to the audience, you will see a notice to complete a survey about today's event. Your feedback is appreciated and helps the Society when planning for future events. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org.
And I'll make one last pitch. Thank you, Jennifer. Apex has a variety of open roles for people based in Chicago, people based in Dallas, technologists based in Portland. So I would be remiss if I didn't say to an organization like this that if you or your network are looking for a new opportunity in the way that I described it, if that's interesting to you, please don't hesitate to reach out to me on LinkedIn or elsewhere. And I really appreciated the chance to talk to you guys. I hope it was useful. Jennifer, thank you for inviting me.
Absolutely. Thank you.